Yeah, hi. Thank you, Prabhu, for the kind introduction, and thank you to all of you for joining us on this Saturday morning and attending the webinar. So, just before starting the webinar, a quick disclaimer that the sectors or stocks that we'll be discussing in this webinar are just for the educational purpose, and please don't consider that as an investment advice. Do consult with your financial advisor or do your own search before investing in those stocks or sectors. So, before moving to the agenda for the today's discussion, we were spotlighting on the best performing mid-cap fund, but before that, we thought that there has been a severe correction in the market, and it makes sense to go through some of the exogenous variables which are impacting the market sentiments and see, like, we if we can have some view on this. So, share our view on this. So, coming to the part, there are a lot of variables out there which are very difficult to predict, right? And these variables are not in our hand, and this could be there is a higher degree of uncertainty on, forecasting their outcome. So we don't necessarily try to forecast those variables, but still, since we are grappling with a lot of like geopolitical crisis on the Ukraine-Russia front, we have a severe inflation problem back in US, and then there is a fair trade hike meeting which is going to happen, and people are speculating for a longer period of time how that is going to pan out. Will that increase the risk premium for the markets, or when will the FI selling will stop? So these are the things that are pertinent questions and impacting the retail investors, right? So today we'll be discussing about those factors from a historical point of view, how these events have panned out in the past, and what's the one thing that we can take home from those events, right? And that can help us in making our future investments better. So coming to the most boiling question of today, right? The questions have been in discussion over the past 1 year. How the Fed rate hike cycle will pan out, and what would be the severity or the quantum of increase in rate hike. So in the past, there has been three rate hike cycles in last 2 decades, and the first one being in 1999 to 2000, where the Fed hiked the rate from by around 2%. So in the time frame, Nifty was up around 30%. Second, the Fed hiked the rate around 4 or 5%, just before the global financial crisis, and the Nifty was up around 90% in 3 years time frame. And the last one being very recent, from 15 to 19, the Fed hiked the rate by 2%, and Nifty was up around 48% in the same time frame. Right. So if we look at the initial period of rate hike cycle, there has always been a dip. It means that market is always uncertain how the cycle will pan out. Right. So because of the uncertainty, market would try to discount a higher risk premium. In fact, if you look at the 10-year G-Sec yield, it's hovering around 2%, right? 1.9, 1.82%. It means that market is already factoring in a rate hike up to 2% over next 1.5 year. So those sort of risks are already built in the system, and because of which the risk premiums have gone up, and the market is seeing some sort of correction. But what we feel that once we mature in this rate hike cycle, this rate hike decision will have a very little impact on the actual stock price. So, for example, let's say we are just going in for the first rate hike on the Feb 15, so that will bring some volatility in the market. But that decisions of rate hike will have a rate hike decision on 15, and then we have 2 months to observe the effect of it, right? And then there will be a June rate hike. So we think that internally that the rate hike decision will not impact the market going forward from quarter 3 onwards. That will have the impact just before the nervousness before the rate hike cycle, the decision till the second rate hike, and post that, once we have the prints and commentary coming into the picture, so that nervousness will out of the game, right? So just if we get some sort of volatility on account of the fate rate hike decision, so just use as opportunity to invest in the market, because we have seen historically also the earnings take a center stage once we are into the rate hike cycle, and not just the rate hike decision, right? So the quantum could be more, but the growth is also there in the economy. If the growth is also there in the economy, and the stock price will follow the suit. So that was a takeaway from this past Fed rate hike cycle. If we can just move to the second slide, we can look at how market has reacted to the geopolitical risk. So this is a graph of last three wars that we have seen. The first is the Kargil war, the second is the Iraq war in 2003, and the latest being the Russia-Crimea war in 2014, which is the more relatable one, right? So these are absolutely uncertain scenarios, and nobody has built us built these kind of scenarios in the models and have forecasted that beforehand. But and that's why we see some near-term volatility also because of these factors. But when we look at how the market has reacted once the events have subsided, right? So market has been quite generous once year down the line. If you look at the returns, so after Kargil war, the market was up around 37%. After Iraq war, the market was up around 68%. Similarly, Russia, Crimea, short-term volatility market was down 3-4% because on the conflict day. But post 1 year, the market was up around 45%. So we are of no view that this is the bottom of the market, and from here on we can see some astounding growth in the market. But we are of the view that this whatever the volatility is there, the worst has already been factored in. We can see some sort of consolidation, some bit of more correction in the market, but these are the opportunities to put money in the market and not change the asset location per se, right? So we feel that these are the good events to put more money, utilize the correction in the market, and take advantage of the stocks which are now available at a lower valuation, which were not available earlier. And maybe 1 year down the line, we can see the returns coming in from those sort of investments. Now, if you can see the impact of FIA flows, right? So FIA has been a relentless seller in the Indian market from month of October. So since October to yesterday closing, the FIAs have sold around 1.7 lakh crore of Indian equities, and that's a big problem for somebody like the Indian something like Indian economy, which is quite dependent on the hot money, right? So there has been a constant tussle going in between the FIAs and the DIIs, right? And if you look at compare the scenario of the current outflow of 1.7 lakh crore with the huge inflows that we have received just after the COVID, we have received somewhat of inflow of around 2 lakh crore. So most of the hot money which has entered the market, entered the Indian market mainly because chasing the risk on trade, has already been out of the market, right? And from here on, we can see we can build a scenario where there can be outflow of 30 to 50,000 crore of FIA money from the market. But going forward, maybe 3 months down the line, there could be a change in the FIA stance, and they can start pouring back money back in the market. So if you look at the last periods, right, when the FIA has taken out money from the market and the Nifty returns, so obviously Nifty has given a negative return, but the subsequent 1 year returns have been quite astounding, right? So picture a scenario in which after FIAs have bottomed out, there is no FIA money to be taken out from the market, and then once that money and the flow reverses, right, we start receiving the FIA money, and the DIs are constant buyers now. So we'll see a good solid market on the backdrop of good earnings environment. Right, so that will be a very good scenario when the market will start moving up, and there could be a scenario of melt up as well. So that was the key events that we have seen which have impacted the market. Right now, the main takeaway from is that volatility will present itself. Right, and if you can just move to the next slide. And if we just we fear the volatility and change our asset location, then we are doing the damage to our portfolio. Right, there's a 30 years long study in the market which has shown that if we just miss the best 5 days of the market, then we'll lose around 20% of the return from the portfolio. And the best of the days only comes after when there is a violent shakedown in the market. So that has been a learning that if you're invested in the market, just remain invested. If you have diversified your investment, let's say equity, gold, debt, and other asset classes, and because of the correction in the market, let's say Nifty is down around 12%, mid cap index is down around 16%, small cap index is down roughly around 20%, 18%, right? So if there is a change in the asset allocation because of the near term correctness in the market, so just take out some money from the other asset class, maybe debt, gold, or other investment avenues, right? Hybrid schemes, and do a top up in the equity schemes, because these are the environments, times where we can get the stocks at a very reasonable valuation. Just to put thing into perspective, there are only 2 instances when the Nifty has gone down below P of 20. One was in the COVID crisis, and now yesterday the Nifty was around 19.5 or something. So this is last 5 years, mainly because of the correction in the market by 12% and the good solid quarterly numbers that the company is posting. The Nifty it looks very lucrative, at least on the valuation basis. So absolutely, these are the times where we do a deep dive and choose the winners, right, for the next cycle, which can compound your wealth. And on the same
second front, we are going to discuss about the super value scheme, which was the best performing scheme for 2021. It was up around 72% last year against the benchmark return of 47%. That's alpha 35% that the mid cap scheme of ours has generated over the benchmark. And it was a scheme which we are currently holding around 10%. We anticipated some of the volatility and let go, and we are the constant buyers on every point of correction in the market. So without further ado, let's get to know what we do in this scheme. So just before starting, we'll do a quick check, on the philosophy part. What's the philosophy which governed the scheme? If you can just move to the next slide, please. Okay, so here comes the philosophy. It's mainly we strive to deliver the superior risk-adjusted return. And what we mean by superior risk-adjusted return is that we try to deliver a earnings growth superior to the benchmark, but with a lesser volatility, right? And if we can continue to do so over next 4 to 5 year period, then price will follow the suit. And we have an environment in which the portfolio prices will grow more than the benchmark, and they will have slightly lesser volatility as well. So this is the philosophy behind running this scheme, is that we try to strive for superior risk adjusted return. Now coming to the multi-bagger framework that we have in place, right? So if you can just move to the next slide. So mainly whatever the stocks that we onboard in this portfolio, this is a very concentrated portfolio of 15 to 20 stocks, depending on what kind of risk environment we are in, right? So let's say when we are in a volatile environment, we diversify the tail to 20 stocks. When we are in a very concentrated bull market like last year, so we concentrate the holdings to 15 stocks. So mainly, but whatever the stocks that we hold in the portfolio comes from this multi-bagger framework, which is a mix of growth and value part. And this is a GAR philosophy, growth at reasonable valuation, we would like to associate this fund with. So mainly on the growth part, what we look at is that the earnings of the portfolio should double at least in next 4 to 5 years time frame. And actually the stocks that we hold in the portfolio, so these are next emerging leaders. So the valuation of these stocks should be lesser than the industry peers, and also lesser than the industry leader, right? So typically the stock that we hold in the portfolio will have PE between 10 to 20, right? And the industry will be trading somewhere between 50, and the industry leader will be trading at, let's say, 80 PE, right? So there are two legs to the growth here. The first will be from the earnings side. The earnings compounding will give a 2x return to the stock price. And the secondly will, once the market will discover that this is small cap stock or mid cap undiscovered stock is growing consistently for 4 to 5 years, then the P rating will happen, and P will move from 15 to, let's say, 30 or 35. So there's a 2x return that will coming from the P rating side. So essentially we are chasing a 4x return, and even in a scenario when the thesis will not fall in place, right? So let's say for some company specific factor, the earnings have not come in and the stocks has not got derated, re-rated. So mainly out of the 20 stocks that we are holding in the portfolio, even if 75% of the holdings fall and plays as per we have envisaged, so the overall portfolio return will be more than 18. It will be in somewhere in the range of 18 to 20% over long term time frame. So this is the multi-bagger framework that we employ while selecting the stocks in this portfolio. Now, if we can just move to the next slide. We'll discuss quickly the process part. So this is a slide which is quite generic to all of our schemes. And for those participants who have joined us for the first time, so I'll just quickly take you through what the framework is. So mainly we have a screener framework where we do a deep dive into 1900 companies and select the companies, put a screen of earnings growth, revenue growth, debt to equity, promoter holding, pledging and all. And then I try to identify top 100 companies on the quality aspect. And then on those top 100 companies, we do a deep dive. We try to assign some ranking, right? And we have 25 parameters. We try to assign the ranking across different parameters. And then we have a pecking order of, let's say, top 30 stocks to do a deep dive into, right? Then comes the radar part where we study the modes of the business. We factor in the future financial earnings of the company, model future cash flows. We do a check on the corporate governance side, and we keep on studying the companies over next several quarters. And once we onboard the stock in the portfolio, so then comes the pendulum part where we keep on juggling between the weights, right? So let's say company has rallied ahead of its fundamental, right? And my colleague Vijay will discuss in detail one of the case studies, right? So we take out the company from the portfolio, how we have taken out the companies from the portfolio. right? And let's say some scenario present itself, some idiosyncratic scenario that the company is not doing well. So we go back and study the thesis in the radar part, and we keep track of those variables. So there are two instances when we take out the stock from the portfolio. Either it has rallied ahead of its fundamentals and has given multi-bagger returns, and the next leg of returns, like we expect the stock to consolidate over longer period of time frame, we take out the stock from the portfolio. Or the investment thesis has not fallen in line with what we have thought of, or there is some sort of corporate governance issue that has come up after onboarding the stock in the portfolio. So those are the instances that we study before exiting the stocks completely from the portfolio. So I think that was on the process side. Now we'll hand over the floor to my colleague Vijay, who will be discussing some of the key characteristics of the portfolio, some of the risk associated with it, and some of the key themes to look out for. So over to you, Vijay, now.
Thank you, Prabhat. And moving on, Prabhu, can you please move to the next slide? Yeah, thank you. So now we have gone through the different processes that we follow on the portfolio side and which kind of companies that we are picking in. So now we will mainly focus on how the portfolio will look like and some of the characteristics of the portfolio at an overall level, so that we can better understand that how portfolio will compound in terms of price as well as its earnings in the next 3 to 5 years. So basically, if we look at the portfolio construct, so that is coming from mainly from the mid and small cap segment for this particular strategy called super value. So we are picking up the emerging leader from different segment like paints, adhesives, or pipes and cables, wires and cable. Okay, so basically we are trying to pick business which is following the footsteps of the leader, which is which has already faced the issues and they have successfully built the industry and they have gained the industry leader status. So we are trying to find the next emerging leader which is following the paths of the already successful leader in the same segment. Secondly, when we are picking this business, so what we are betting on is we are betting on the profit growth of the company of that particular business for next 3 to 5 years. So our aim is to minimum the company or business should compound its profit for the at the 20% CAGR for the next 3 to 5 years. Okay. So one thing that I would like to focus on this 20% growth side, that we need to understand there are two parts to the growth in the portfolio. So one is the market link part, which is the in terms of the share price, and another is the fundamental growth, which is coming through the profit and loss statement or the balance sheet side. So we are betting mainly on the profit growth side, not on the market volatility or the market price fluctuations. So it may happen that market will not give 20% growth each year, or it will not factor in like it happened in the past when COVID struck and there was sudden fall in the stock prices across the index by more than 30%. And eventually there has been a good bull market for the last 1.5 years, now completing almost 2 years in this March. So our goal is to not get distracted by this kind of stuff, but stick to the fundamental thing, which is the growth should be in line what we have discussed for the portfolio level, which is a 20%. Third thing is that the management of the particular business who is running the day-to-day operations and which has taken the charge to grow the profit at 20% growth for the next 3 to 5 years. In simple terms, they are trying to double the earnings and the revenue. So they should be very investor friendly, and they should be also transparent in accepting the mistakes which they have committed during the time. And we are we are fine with committing the mistakes from the management side, but we are more interested in their approach to correct the mistakes which has happened with the few of our companies in the portfolio in the past as well. So one of the company that we hold in the portfolio from wires and cable segment under the name of KEI Industry, it had faced severe issues from the government contracts in the past, but they accepted the mistake and they did the course correction subsequently, and there has been a very heavy good bull run in the same segment. So we always prefer management which is transparent and they are more solution oriented rather than focusing on the problem and getting distracted on the other issues. Fourth point on the valuation side, like Prabhat has also mentioned, that the valuation of this particular businesses that we are picking in the portfolios are less than the industry average and also at the discount to the industry leader. So that gives us sufficient margin of safety in case of the thesis is not playing out well, or let's say some exogenous factors strike out like war or some kind of disease or some kind of geopolitical risk which is coming out from various scenario like inflation or interest rate or some terrorist activity. So we have sufficient margin of safety in that case. And lastly, when we have finalized this 15 to 20 businesses, depending on the market environment, we try to hold it for the long period, which is around 3 to 5 years of a horizon. So we expect that these companies will post results on every quarter, and we will try to understand how they are building their journey towards the final goal that they have set for them in the future. But for us, the risk is not the market volatility or the market price fluctuation that we discussed earlier. For us, the risk comes from three main segments, which Prabhu, can you move to the next slide? Yeah. So we think the major business risk, comes from the three different segments, three types of risk. So first is the business risk, second is the valuation risk, third is the corporate governance risk. So now we will understand like how these three key risk factors can affect our portfolio and also impact the individual holding on a particular business level. So first is the business risk. So in this category of risk, we do not pick businesses whose revenues or the business model are unpredictable or uncertain. So what we mean by that, so we are not picking any business which have a cyclical growth or let's say the very heavy correlation to the economic growth. We are trying to pick business like consumption sector or the building material segment, which has a very secular growth. So they are not like much impacted by the macro environment or the inflation kind of temporary phenomenon, and also they are not highly leveraged kind of companies. So that is on the business risk side. Second thing is a valuation risk, like we discussed earlier as well, that our approach has always been to pick businesses which are available at a discount in terms of valuation to the industry peer and industry average. So that in return gives us the heavy margin of safety in case like if the thesis is not playing out, we will be supported by the low price to earnings or low price to book multiple, which can decrease the impact of the particular holding. So we never pick the businesses which are trading at a higher valuation and is not justified by the growth that is going to generate in next 4-5 years. Lastly, for us, the corporate governance risk is a very important one, because when we are picking business, so we are constantly interacting with the management. So we understand there are two parts to the management saying. So there is one thing is the capability of the management, and second is the intention of management. So what we have observed in our investing period is that some of the managements are very capable, but their intention is not true to the investors. So we never align ourselves, or we never pick the businesses where we are not comfortable in the management side, and we are very strong when we think that their management is not allocating the capital in a sufficient manner. So we will strictly take exit in those cases. It has happened in the past as well, and one of the pharma company that we used to hold had a very major impact in terms of corporate governance as well, and also on the demand side as well. So we ended up exiting the business, even though like it was in some minor profit and loss for some of the clients, but we are not like okay with the investments mistakes or the corporate governance side. And subsequently in next couple of quarters, when the issue became too burning, the stock ended up falling more than 40%. So we are not okay with the company which is having like the not transparency issues, or let's say they are not investor friendly, not open to talk with the investor. So we will consciously avoid these companies. Now to put all the things that we have discussed in perspective, we will go through one of the case study of one of the past stock or past business that we used to hold, and it will help us to understand how the portfolio journey or the business level journey happens in the portfolio level. Yeah, please move to the next slide, Prabhu. Yeah. So the business that we used to hold in across our schemes is IRCTC. So just to make a disclosure, this is not an investment recommendation or not a recommendation from our side as a fund house. So this is just a case study for education purpose. So IRCTC had been great listed in the stock market somewhere around October 2019, and we were quite interested in the IRCTC as a business level because it had a very monopoly kind of business model, and the return on capital employed was very high, and the working capital cycle is very less, and they were expanding into the multiple segments like the bus segment and also the rail near plant expansion. And also they were beneficiary of the privatization of the trains. Around 150 trains were under privatization at that time. So what we thought, like there is a good opportunity to build a solid case for the wealth creation in this business. So we set the target for the future as well. So when we invested in calendar year 2019, we had set the target in 2024. The IRCTC profit will grow from 450 odd crore to 1600 crore, and its market cap, depending on the valuation, which was very cheap at that time at 35x, will grow to 60 to 65x, which will lead to the market cap of somewhere around 1 lakh crore. So the goal that we had set for around 5 years, somewhere around calendar year 24. But what had happened in this journey, there has been a huge bull market, and there has been a huge bear market when the COVID came. So if we talk about the stock price, we invested somewhere around 1,000 rupees. Then later on, it went up to 2,000 rupees. Then Corona came and stock went all the way to 900 rupees. Then it subsequently bounced back to 1,900. And again, the OFS came from the government side. So we are not disturbed by this kind of things which are happening, which is not related to fundamental things. And we did not change our portfolio allocation, or let's say the industry, the allocation to this particular business. And subsequently, when people realized the true fundamental, when the economy started bouncing back, this future that we decided would play out at the end of the 5 year subsequently happened in the only 2 years. So in calendar year 21, when IRCTC reached before split around 6,000 rupees, we ended up exiting the stock at a completely at across all the strategies. It hit the market cap of 1 lakh crore. So what we try to make out of this case study is that sometimes it may happen that businesses which are very strong in terms of earnings can have short-term fluctuations which happened in the Corona, or let's say the OFS, which the government brought very aggressively, hammering the price by 20% on the IRCTC. But it does not impact the portfolio fundamentals, or let's say the business fundamentals, and eventually stock price will also catch up the fundamentals, which happened with this one. And stock hit the high of around 6,200, and we ended up exiting completely. And the proceeds that we got from this particular business, because it had been a huge wealth creator for our clients and our portfolio level. So we consciously decided the valuation is not justified, because the profit of the next 5 years have been already factored in the next 2 years. So we don't want to take excessive risk of valuation when the expectation is pretty much factored in. So we took out the holding on the all level, and we deployed it to some of the growing themes that we thought that are still attractive. So Prabhu, please move to the next slide. So these are the 6 different themes that we have mainly focused on our portfolio, and some of the portfolio links that we have rejigged, and the profit that we received from the IRCTC and different companies like GMM Fordler, we ended up distributing towards this 6 segments. So first segment, that is coming from the IT side, which is a communication platform and consumer intelligence platform side. Second is the PVC pipe and agrochem theme. So we are very bullish on the housing theme. So this is a huge beneficiary of the housing theme as well. And the third is the PLI beneficiary. So PLI, the government has been very aggressive on the announcement of the different PLI schemes for the contract manufacturing side. So that is the third theme. Fourth is the building material theme. If we look at the wires and cables and the wood coating paints, so we are very bullish on them, because we still think there is a huge growth opportunity which is left in the industry, and also the valuation which is very cheap versus the industry, other industry which are trading at higher premium multiples. Fifth and sixth theme are quite interesting. So these are our future bets. So we understand that EV is going to take over the internal combustion engines going forward, and we will see like massive industry creation in the electrical vehicle side. So we have consciously placed two bets for to play this thesis. So one is through the Li-ion electrolyte, which is basically used in the battery of the particular electric vehicle. And second is a business which is a technology leader in the particular segment. So we are not betting on the front end themes like the company which are manufacturing the final product. So we know that if the particular company, let's say, fails the particular business model, they will suffer hugely. But a company who is making auto ancillary parts for a final product, so they will have 10, 15 clients. So even if the one company's a business, the car model or the bike model fails, it does not impact that much. So we have consciously placed the bet in a leader, which is a technology leader in the Indian auto ancillary side. So these are some of the things that we are very bullish, and we have consciously met those managements, and we think that they have a true potential to deliver the huge wealth for the shareholders as well, and also in terms of the balance sheet growth that they are going to create in the next 5 years. So moving on, so Prabhu, please move to the next slide. So the efforts that we have put in terms of the portfolio creation and talking with the management and going to the various industry reports and research reports. So this all these efforts have led to the huge wealth creation for our investors. And our goal always has been to create wealth in the long term, not on the quarterly or the, let's say, the some 6 months horizon. We always maintain our conscious stance that in next 3 to 4 years we are looking to double our portfolio earnings, and similar to that, our portfolios will also re-rate in terms of the price and exhibit the same behavior in terms of the share price as well. So we understand that the some of the market volatility which comes from the exogenous factor can affect our temperament and attitude towards the investment decisions. So at Right Horizons, we have strictly adopted a mindset model or the investing model that we have perfected over the time. And we think that anyone who is investing passionately in the stock market, we strongly believe that 50% of the things come from the financial study or the research that one carries out by understanding the business model, talking with the management. But another 50% of the investment return or the investment impact comes from the psychological behavior or the investor behavior towards the market. So we would also like to put and discuss some of the interesting things that we have adopted at the Right Horizon, so that people and industry at a whole level, the stock market communicate, have also the benefits that we are also getting. So Prabhu, please move to the next slide. Yeah. So this is the behavioral framework that we have adopted. So there are three different tenets that we have adopted at a Right Horizon PMS level. So we strongly believe that market is just a place to buy and sell shares, nothing more than that. So just to put things in perspective, let's say there has been a huge rally in some of the penny stock because of the excess liquidity. And when the liquidity is drying up, the stock prices are collapsing on the 5% circuit level on the daily basis. So when the stock price is increasing, it does not mean that the business is doing well. We need to dig further, because the market price or the stock price of the particular business can fluctuate due to some of the reasons which are not related to fundamental, like liquidity, or some of the things like the stock market price manipulation and all this stuff. So for us, the problem is not the price volatility. We are strongly focused on the business volatility, which is coming from the cash flow side. So for us, the main problem is that when the business is not delivering the revenue growth or the profit growth that what we have fixed for the particular company. So we are okay with the company. If, let's say company has a target 20% growth and is generating 18% for a year and 22% for a next year, we are fine with that. But when it comes to the stock price behavior, so stock price will not behave like that. It may run a 40% in a single year, and it may happen that by second year it can go down by 10% because of the various factors. Some of the war related factors had seen the huge impact in terms of the valuation of the across the whole industry. So that is a good opportunity, but we are not changing our investment thesis based on that. Second thing is the long term per se. So why we are focusing on the long term? Because if we look at the daily progress of a particular business. So it is very slow or incrementally very slow to build a business over the period of time. The efforts that they put in on the daily basis will only be visible when the years are passing by or when the subsequent quarters are passing by. So there is a very interesting thing that we want to share with the investors as well and the viewers that are attending the webinar, that we need to be consciously sure that result of the company only comes once in a quarter. That is a 90 days. Out of this 90 days, only one day is important to us when the company is making disclosing their financial numbers and talking about their future vision and how they are going to achieve it. Rest 89 days is just noise, or let's say the some of the external events. Because of that, stock price is fluctuating because some buyers or investors are trading or selling stocks. So for us, that one day becomes very important. Other 89 days can be just noise or some random fluctuations which does not give us material information about the company's future. So we strongly believe that we should not be swayed away by, or let's say the distracted by the daily stock price movements. We should always focus on the fundamental growth of the business rather than focusing on the stock price in the short term. Lastly, we strongly believe that the energy and the resources have limited to every human being, and we should be very consciously using those. So as we have discussed that we are picking around 20 businesses in this portfolio. So we strongly know if we divide the 20 businesses in terms of days per year, so in 365 days, we can only spend around 17 and a half days per business. Okay, so let's say if we pick 50 businesses, so that time will decrease heavily towards only 7 days per business in a week, in a year. So we have consciously taken this bet that we will not focus, we will not diversify our focus to 40-50 businesses. We will stick with the 20 businesses so that we can study those businesses in depth and our conviction becomes higher than the street as a whole, because we are focusing our resources on a particular business for more time. And also, if we, let's say, if we want to predict the Nifty 50 index movement, so we need to study the 50 stocks and determine their future, which is a fairly complicated one, because studying 50 businesses will take huge time versus studying the 20 businesses. So these are the three tenets that one can adopt and create the strong portfolio and get the long-term compounding benefit of this India growth story. But this may look simple in terms of when we are talking about in theory, but when it comes to execution, it can be very difficult, because when the thesis, or let's say the market is fluctuated by some of the external factors and stock price is falling down, so it is very difficult to hold the conviction. And it is very natural for as a human being to have fear in terms of the market. But as we have shown in the data that this volatility can become our friend. If we have additional funds to deploy, we can deploy. Otherwise, we can just sit tight and let the market recover on its own, because these short-term events don't justify, or let's say don't change the future that the company is building on the daily basis. So I think that is the whole idea from our side of the investment side. With this, we would like to conclude the presentation, and Prabhu, we can begin the Q&A session. So over to you, Prabhu. Thank you.
Yes, sir. Thank you. Thank you very much, sir. So starting with the first question we have is, sir, what sectors are you bullish on? Like you have thrown some light on what are all the future winners, but if you could throw some more light on what sectors are you bullish on?
Yeah. So to be specific, so we are very bullish on some of the housing and building material themes. So the rationale behind is very simple. Okay, so if we talk about, let's say, the wires and cables industry, so the industry has been growing that 13% volume growth for last 20 years. Okay, and if we look at the current industry growth, that is also somewhere around 14%, and the industry level data that showcases the forecast for the next 5 years. So it is also growing at a 13 to 14% kind of growth. So we strongly believe this story is still a huge growth story. And in terms of we talking about the valuation, the valuations are very cheap if we compare to some of the broad names like the industry leaders kind of Asian Paints, or let's say we are talking about Pidilite. So the companies that, or the businesses which are trading in the available in the wires and cable segment are very cheap from the valuation per se. So that is the one thing that one can play on this wires and cable segment, which is a secular growth story, not a cyclical one. And the second is the electrical vehicle theme. So there are two parts to it because electric vehicle are normally the function of the battery and also the physical model of the or the architecture of the particular car. So we are playing this theme by two different ways. So one of our bet is on the electrolyte side, which is a solution which is used in the lithium ion battery, and the company has already started manufacturing the electrolyte for three primary customers. And our second bet comes from the segment which is the auto ancillary side. So we are not betting on some of the car manufacturer like Tata Motors or something, because we know the risk that comes from the model failure of the particular side. So if we look at the even the global level car players, so most of the wealth creation has happened from the auto ancillary side, because auto ancillaries have 10 15 different consumers or the final car makers that they are providing the auto ancillary parts. So even if the one of the company, let's say the Maruti or Tata Motor fails to gain the market share through their business new model, so the company is not impacted that much, and we are not like looking for the returns only. Our primary goal has always been to focus on the risk and how can we utilize those risks to our benefit. So I would also like to invite Prabhat to show more light if anything to add on this side. Yeah.
Yeah, thanks, Vijay. So just to like expand on the EV side, right? So what we feel is the EV space is just at the cusp of expansion. What auto industry is at the stage of 1991, and like like EVs are the big disruptors in the industry, right? So we expect the industry to grow at more than 45% CAGR over next 4 to 5 years, and government is also coming up with a lot of initiatives like PLI and FAME to like boost the EV penetration. So on the OEM side, we favor two-wheelers over PVs, although we don't hold any hold any OEM companies in the portfolio. But since like over 80% of all the vehicles are two-wheelers, so we feel that the volume could be a lot higher on the two-wheeler side in the starting years, right? So if somebody has to pick out like choose on the OEM side, so they can go for the two-wheeler side. What we personally feel is, as the Vijay has highlighted, that we look for the ancillary companies, right? And we have onboarded automation company which has a very robust growth prospect and and it has an order book of more than 10 years, right? And is coming up with a program, very long-term contracts, which gives the good visibility on the company's revenue and the growth prospect. So that side, mainly we those sort of stories would like to hold, and they have good growth prospect to go up in future. Yeah.
Yeah, thank you, sir. So one of the viewers has posted a question saying that we see a lot of talk around e-mobility, and then worry is that it is too complex and challenges of deployment. So we have seen similar noise around solar and alternate energy in 2006 or 7, and it all blows over post. It's all blown over post 2008. So how is the situation different now?
So if I'll just take this question, right? So mainly like there is no certainty, and again there is an anxiety issue also in the EV adoption, right? So what we feel is that diversify the risk by not just focusing on the Indian specific players, right? But go for the OEM players where they have some contracts on the global side, right? So for example, the company that we are holding in the portfolio have roughly more than 50% coming from the global side and very few on the domestic side. And it's not just 100% again EV play. Some bit is also coming from the traditional IC side, right? So that's how you diversify the risk. And the risk is one part if the growth pans out, right? Because we are at a very nascent stage, right? And the industry is expected to, as I mentioned earlier, 45% CAGR. So if the growth pans out, then that would be good. That would be quite beneficial for the company. And again, always look for the order books while selecting such stories, because order books will give you such visibility, right? If you look at the Maruti, right, at one point of time it was manufacturing 1.8 lakhs car, and now it's manufacturing 1.2 lakhs car, right? So those sort of fluctuations will happen, and that will take away the entire juice from the company. But if we have some sort of growth, good visibility over the longer time horizon, then I think that's a good way to play about it.
Yeah, just to add on this point, so I attended one of the Bloomberg conference on the renewable energy in the past as well, and I have been attending it on multiple front side. So on the solar and the wind energy, if we talk about, so we have the solar and the wind energy has been in the market on the global side from 1970s. Their roots are way back in US and the France when they started talking and advocating the use of the solar and wind energy. But if you look at the commercial viability of those products or that energy was never at par commercially viable if we're talking about the traditional source of energy like coal or the energy which we go to the hydro plant or something, nuclear energy. Okay. But what has happened in the last decade, so the solar PV module prices have come down by 80%, and the viability of those solar PV modules or producing the 1 unit of energy from the solar has become equal, or even it has gone down now to the, if we are manufacturing or producing 1 unit of electricity to the coal consumption and all. So when we are talking about some of the green energy and the renewable energy theme, we have to be very sure that even the technology has been around for more than 5 decades, but people will always start using if it's commercially viable or it is economically viable. So the cheapness of the energy or the cheapness of the newer technology should be there, which was not there in the last 4 decades till 2010. But subsequently we saw the technology coming up with the cheap wafers on the solar PV module side, and some of the integration that they did on supply chain. So that brought down the whole price of the value chain. Similarly, when we are talking about the EV side, so we have seen the strong usage on the global market side. And as Prabhat has already highlighted, the business that we picked up consciously is also already supplying the raw material or the auto ancillary parts to the US large companies or the leader in the electric car segment. So we won't disclose the name, but people can take an educated guess from this information. So this is the way that we are trying to diversify the risk. We know that some of the things will not play out in the the emerging theme side as what we envisage, but we need to also understand the commercial viability, which has increased heavily on the e-commerce electric vehicle sides versus the IC engine. So that's how we are playing this theme through the commercial viability point of view as well, and also the some of the risks that can come from the high growth expansion and supply chain disruption.
Thank you, sir. So one of the viewers has asked, can you provide how you are performing for the last 6 months?
So what we can do, maybe we can share the details of the returns in an offline mode. Okay, so that will help us to understand the various performance of the schemes on the 6 months, 1 year, 2 year, or the since inception time. But we strongly believe to understand any fund, or let's say any fund houses which are listed or which are available in the market or the industry as a whole. So one should not focus on the 6 months or 1 year return. It doesn't say anything about the fund manager conviction on the fund manager side, because no one is looking to invest for, we are investing for the next 3 to 5 years. So it's good to have a long-term track record. So that can help us to present the two picture. Like in our case, we are always have been advocating that we are picking up the business which is growing at a 20% growth for the next 3 to 5 years. So the returns will be also similar into that line, because stock price is stock price is only the reflection of what is happening to the profit growth side. Yeah.
Thank you, sir. So you spoke about stock prices reflecting about the profit growth. So one of the sectors would be finance. So we are seeing that banking stocks are underperforming the broader market, but valuations are reasonable. Asset qualities have been improving, but then the prices are not reflecting that. So how do we see this playing out?
So I would like to have initial note on this question. So there has been lots of worry around the provisions and the NPA kicking in because of the multiple COVID waves. But we have seen that that market is not a place where the fundamentals will immediately get reflected in the price as well, which happened with the IRCTC, one of our holding. So it has been stagnant until the actual recovery started kicking in. It has been 3-4 quarters when the government started coming in and did the OFS, and there has been a COVID shutdown of trains. So these things do not take that much do not shake our like conviction on the finance side as well. So finance stocks have been accumulating earnings, and we have strongly focused on the NBFCs or the housing finance companies which do not have the past cycle burden. Okay, so we have to understand when the banks or the any NBFC who have past NPAs, so they will not be able to focus on growth side because they are also spending their time and team resources on getting the pending loan which is due from the older clients. So we have consciously picked up some of the NBFCs which have started through the fresh round of funding from the investor side, and they have a very less past burden of recovering the assets or the loan assets which were due and they were not paid by the investors. So they are not focusing on recovery, they are only focusing on the growth side. So this is how one should also look at. So one should not always play on the bank or NBFC theme which is like focusing or dividing their attention on the both side, because we know that the time is limited, so one can always eat away the other part of the growth. So that's how we are, our views on the financial side. Yeah.
Thank you, sir. So the last question would be, so one of the viewers has posted, utility stocks have not created value, and electric vehicle too would be a challenge of pricing and would always be an issue on margins. How do we get value from this?
Yeah. So so we need to understand that the reason that how we are playing is EV. Again, also thought of there is a whole process that why we picked up some of the names from the electrolyte side or the some of the auto ancillary side. So when this company is let's say this electrolyte manufacturing company is manufacturing the solution for the final company, so they have a very fixed margin. Okay, and those contracts are for the 5 to 7 years horizon. Okay, so the margins will remain stable for 5 to 7 years even though the final product is not selling at a price that we desire. So as a auto ancillary or let's say as a contract manufacturer, your margins are secured, and let's say if the final product manufacturer, let's say the Tata Motors, has given order to a company and the model is not selling at par what Tata Motors has envisioned, so the contract can be terminated, but there will be a one-time major payment which will come from the Tata Motors side to the company which is manufacturing electrolyte for that segment. Okay, so that is how these businesses are protected. So anytime like any investor who wants to put money in the emerging thing, they should not bet on the final value chain player who is manufacturing the final product, because the probability of loss is very higher for that company. But a company which is providing just a auto, like let's say the ancillary parts, will have a very minimum impact because they are catering to the different clients. So that is the thing on the margin side as well. Also, when we are talking about the auto ancillary side, that company has also a stable margin because their long-term contracts are for the 10 to 12 years with the US clients. So those margins are protected for the next 10, 12 years. The bet on the utility always must be consistent with the margin. I think the question has come from a very like bright mind person who has always thought from that deep point that margins will determine the sustainability of the business going forward. So that's how like we also think that margin should be consistent in the long range and the long term as well. So that's why we pick businesses which have like a 10, 12 years growth visibility, especially when it comes to the company which is making products or the segments which is the growing or the emerging theme side. So anything you would like to add, Prabhat, or?
No, so I guess we have a limited time, so we can just take one more question and then we can look to end the session now. Yeah, Prabhu, we can take one last question.
Okay, sir. So, sir, one more question again, dominating is the electrical vehicle industry itself. So the question is, how do you see the trends and the development, being played out?
Yeah, so on the EV side, we have rightly, like we have earlier also pointed out that like two-wheelers are going to be the first sort of beneficiary on the OEM side, and on the this ancillary side. So mainly we can look to have companies like I'll disclose the name, the company that we are holding in the portfolio, it's Sona Comstar, because one of the gentlemen is also asking about the name, and the other is the Neogen Chemicals that we are holding. It's a lithium-ion, the company provides a lithium-ion electrolyte solution. So these two companies are holding, and we are holding the exposure on a very diversified manner, right? It's not directly linked to the auto side also. Plus, they have some core businesses other than the EV space, right? And they have just like since the EV opportunity has presented itself, they have like set up capacities to cater to that demand. So in case there are some sort of headwinds or like the growth doesn't pan out the way, because we are all factoring in a very high growth environment in our estimate. If the growth doesn't pan out in that manner, so we have some sort of like something to fall back on, right? So this is how we are playing the EV story. I hope like that answers the question and also helps our participants. Yeah. So Prabhu, I think we are running short of time, so maybe we can take other questions offline, and we can reach out to the investors individually as well, the participants who are there online, and we can look to conclude the session now.
Okay, sir. Okay, sir. Thank you, participants. Thank you on behalf of Right Horizons. We would be concluding the webinar. You may now disconnect.
Thank you so much, everybody, for joining in today.
Thank you, everyone, for your time.